Hey everyone, Robert here from The Alternative Investor. Today we're diving into the dramatic rise and recent sharp drop of Applied Digital, ticker symbol APLD. This stock exploded over the past year, gaining attention in the AI and high-performance computing sectors. But after missing earnings, it crashed nearly 30% in a single session. Let's break down what happened, what the financials reveal, and whether this is a dip to buy or a signal to bail. Applied Digital stock has experienced extreme volatility. After climbing to a 52-week high of $12.48 on high growth expectations and AI sector momentum, the stock has now dropped to around $3.90. That's a nearly 70% collapse from its peak, and most of that drop came after its most recent earnings report. This kind of movement is attracting both concern and curiosity across the investor community. In its third quarter, Applied Digital reported $52.9 million in revenue, which marked a 22% year-over-year increase. However, this still fell significantly short of Wall Street expectations, which were forecasting around $64.8 million in revenue. This shortfall was one of the major triggers for the stock's drop. The company posted a net loss of $36.1 million, or 16 cents per share, which was an improvement from the prior year's net loss of $62.8 million. While the loss is narrowing, it remains substantial. On an adjusted basis, Applied Digital reported a net loss of $17.8 million or 8 cents per share, which also failed to meet analyst forecasts. There was a bright spot in adjusted EBITDA, which came in at $10 million. That's a major improvement compared to a loss of $1.3 million during the same quarter last year, showing that operational efficiency is improving. The company reported $261.2 million in cash and cash equivalents, giving it some breathing room. But it also has a significant debt load of $689.1 million, which raises concerns about leverage, especially in a high interest rate environment. Despite the earnings miss, analysts remain surprisingly bullish on Applied Digital. The stock currently holds a strong buy consensus rating, and the average price target is $11.67, which suggests a potential upside of nearly 200% from current levels. However, individual analysts have started to adjust their expectations based on recent developments. For example, Needham lowered its price target from $11 to $10, signaling caution while maintaining a positive outlook. Meanwhile, H.C. Wainwright cut its target from $12 to $7, reflecting a more conservative stance in light of execution risks. Interestingly, Northland Capital Markets raised its target from $12 to $20, showing confidence in Applied Digital's long-term vision and scalability. There are three primary reasons behind the stock's sharp decline. First, the revenue miss was substantial. Missing expectations by over $10 million raised red flags about whether the company can sustain its previously impressive growth rate. Second, the company cited technical challenges during its earnings call, specifically issues with transitioning GPU capacity to newer cloud clients. These operational hiccups impacted their cloud services revenue, which dropped from $27.7 million last quarter to $17.8 million this quarter, despite being up year over year. Finally, sentiment played a big role. Applied Digital had become a retail favorite and was priced for perfection after its meteoric rise. So when the company stumbled, even slightly, the sell-off was fast and severe. Classic momentum reversal behavior. Despite short-term headwinds, Applied Digital still has its eyes on long-term expansion. Its focus on high-performance computing and AI workloads puts it in a space that's expected to grow for years. The company recently announced a $375 million financing deal with Sumitomo Mitsui Banking Corporation, which is earmarked for building out additional data center infrastructure. A move that suggests continued commitment to scaling capacity and reaching profitability. Execution, however, is now under the microscope. Investors will be watching closely to see if management can fix the issues, deliver sequential growth, and bring down operational losses while expanding high-margin services. Applied Digital's story is far from over. While this recent crash was brutal, the company's improving EBITDA, long-term sector positioning and continued analyst support suggest there could be light at the end of the tunnel. But the risks are real, and now more visible than ever. This could be a buying opportunity for risk-tolerant investors, or a warning sign, depending on your time horizon and strategy. What do you think? Is this a bargain basement opportunity in the AI infrastructure space, or a falling knife? Let me know your thoughts in the comments, and don't forget to like, subscribe, and tap that bell so you never miss a beat here on The Alternative Investor.